Welcome back to the deep dive. When you look at those really successful real estate tycoons, the ones building these fortunes seemingly out of nowhere,
Uh-huh.
it really does feel like they've got some kind of Midas touch. They just seem so confident, so knowledgeable, and honestly just lucky.
Yeah, that idea of magic, it's a good story, isn't it? But the truth, at least according to the pros who've been in the trenches, is that luck really has very little to do with it.
Sure.
What those golden few achieve, it's not about charms or chance. It's built on, well, really rigorous systems, clear formulas, and maybe most importantly, just extreme preparedness.
Right. And that's really what we're digging into today. Our source material, it comes from someone deep in this world, and it basically gives you a shortcut.
Mm-hmm.
It cuts through the myths and lays out the actual fundamental methods these expert investors use. It's like getting the blueprints, not just admiring the finished building.
Exactly. The aim here is to get you past thinking it's all about luck and to show you, look, it's about being incredibly systematic.
Okay, let's unpack this. Let's start with some of those core myths, the ones that really hold people back. So the first big one people run into is just money, right? This idea you have to be, well, already wealthy. Like you need huge amounts saved up just to start investing seriously.
Oh, absolutely. That's probably the biggest roadblock right there. But the foundational idea the real pros work from is that the deal is the hero.
The deal is the hero.
Yeah. If the deal itself is solid, financially sound, offers great potential return, the money tends to flow. The material we looked at draws this great contrast, between starting small and starting smart.
Ah, the small start versus the, let's say, the bigger play.
Precisely. There's this example of an early deal. An investor put down $20,000 of his own money on a condo worth about $116,000. 5 years on, his profit was pretty modest, like $5,000.
Okay.
Now, compare that to a recent deal. A $9 million, 182-unit apartment complex. The investor. $0 of his own cash down.
Wow, okay.
He raised the $2 million down payment from partners. And for structuring and managing the whole thing, he kept 10% ownership. That 10% share. It appreciated by over $200,000 in less than a year.
That zero down thing. It sounds almost, well, too good to be true. What are the risks there? I mean, the source must mention downsides when you're dealing with partners like that.
Well, the risk shifts, doesn't it? It's less about your personal financial liability and more about performance. You absolutely have to deliver on the plan you promised your partners.
Right.
But the big takeaway is you don't have to start small. For these larger commercial properties, the loan is often secured more by the asset's value, its earning potential, than by the buyer's personal bank account.
And critically, the risk exposure is actually lower with bigger properties, isn't it? If you buy a little fourplex and one tenant leaves, boom, 25% of your income gone.
Gone instantly. But with, say, an 8-unit building, one vacancy is only, 12.5% exposure?
That's more manageable.
Your occupancy risk is just spread so much thinner. It gives you a much more stable cash flow right from the start. And because commercial property value is tied directly to its cash flow, when you improve the management, you're actually controlling the appreciation yourself.
Okay, moving to another foundational piece. The sources really hammer this home. Goals aren't optional. They're like a requirement for actually doing anything.
Yeah, a goal that isn't written down, it's just a wish, basically. The experts are really clear. Your goal has to be measurable. It has to be attainable. These vague things like, oh, I want to invest in real estate someday, they give your team nothing to work with.
The power of getting specific is pretty amazing. They gave this example, didn't they, for communicating what you actually intend to do.
Yeah, something like, we will acquire one 8-unit property in Old Town Scottsdale within the next 12 months.
That will generate at least $4,000 of average annual income over the next 5 years. That's laser focused.
Exactly. And that kind of intention, well, it needs execution. And execution needs a team. The material is adamant. Nobody succeeds alone in this game. The right team saves you time, sure, but more importantly, it prevents really costly, sometimes catastrophic mistakes.
They mentioned that really jarring case study, the investor from Seattle who bought that 100-unit place in Phoenix, completely sight unseen.
Oh, that was a disaster. A total failure of preparation, of due diligence. He had no local team, no local manager, no real feel for the neighborhood at all.
This is what happened.
He ended up buying a property that was falling apart and basically being run by local gangs. He burned through months of lost income and 6 figures in repair costs, just trying to make it safe and livable.
Good grief. That's not investing. That's crisis management.
Yeah.
That story alone makes a case for building a good local team, doesn't it?
Absolutely.
So who are the absolute must-haves, the core players you need from day one?
Right out of the gate, you need 4 key people. An attorney who knows real estate, an accountant, a real estate broker who specializes in investment properties, not just houses, and a property manager. You know, what's fascinating here is how amateurs and pros look at things differently. Amateurs tend to focus almost entirely on the property itself. You know, the curb appeal, does it look nice?
Like the cosmetics.
But the professionals, they know the market is way, way more important than the individual property.
You've got to avoid buying that proverbial swampland, right? The investment that just
Oh.
drains your money and time with no real return. So how do you figure out which market's a winner?
You need a system, a research strategy. It's broken down into roughly 3 levels. Level 1 is basically desktop research, gathering data before you even leave your house.
Okay, so looking for key indicators, like that Portland, Oregon example they used.
Exactly. They looked at public records and found Portland has an urban growth boundary that limits future supply of land for rentals.
Yeah.
Big plus. They also saw a high cost of actually buying a home there. So even if unemployment ticks up a bit, those 2 factors suggest rental demand will likely stay strong.
Okay, makes sense. Then level 2 is getting boots on the ground, face to face.
Yep. That's where you actually meet your potential team members, the brokers, property managers, maybe even city officials. You're confirming or maybe correcting the assumptions you made from your desktop research.
And that helps narrow things down.
It helps you zero in on a specific submarket. In that Portland case, the local guys helped them focus on the downtown area. Why? Because its job market was more diverse, likely to bounce back faster than, say, a suburb relying on just one industry.
Got it. And level 3, that's the ongoing part.
That's integration, locking into the information flow, subscribing to trade reports, tracking government sites, staying plugged in so you're always kind of ahead of the curve, anticipating the next shift.
But all that research, it really hinges on understanding those 3 main drivers of supply and demand, doesn't it?
Absolutely. Get those wrong and the rest doesn't matter much.
If you had to pick just one driver, the absolute non-negotiable one, what is it?
Oh, employment. Hands down. Population follows jobs. Always.
Okay.
You need to look for stability, sure, but also economic diversity. You want to avoid markets that rely too heavily on just one sector, like remember Houston in the 80s. When the energy market crashed, it took the real estate market down with it.
Right. Okay, so employment first. Driver 2 is population and persona. What's that about?
It's about places people are naturally drawn to, often for the lifestyle, the vibe.
Ah, like a living experience.
Exactly. Think Venice Beach or Key West, maybe a cool university town center. The key is spotting those clear population magnets. A new sports stadium going up, a university expanding, maybe a new highway extension opening up access, or a big company relocating its headquarters. Those things can shift demand fast.
Yeah, and the third driver, location. That's more than just where it is on a map.
Oh, yeah. A really great location needs, first, drive-by visibility. That's your best, cheapest advertising. Second, it should have some kind of rare quality, maybe waterfront access, something hard to replicate. And third, it needs to be in a high-demand, low-supply pocket.
Okay, so market fundamentals look good. But the best deals aren't always listed publicly, right? How do you find those?
The really top deals, rarely listed. You have to actively target properties that aren't technically for sale.
What do you even do that?
Public records are your friend. Tax assessor's office, corporate commission websites. You can often find the owner's contact info. Then you just pick up the phone, make a cold call. Often these are older owners, maybe less sophisticated investors who might actually welcome a quiet, direct offer.
Okay, now we're getting into the real tactics. We've done the research, identified a market, maybe even a potential property. How do we turn that into a smart offer price? The core idea seems pretty brutal. The seller's asking price. Just ignore it, basically.
Functionally irrelevant, yes. At least initially. You absolutely have to detach emotionally from their list price and figure out the property's real value based purely on how it's operating right now. That's how you buy wholesale. And buying wholesale is pretty much the only guaranteed way to lock in profit from the start.
Right. So let's walk through the 5 steps they laid out using that Phoenix property example. Step 1.
Step 1, verify the property income. Sellers love to talk about future potential income. You know, the glossy brochure version of what it might earn someday if everything goes perfectly.
Right, the fantasy numbers.
Your job is to nail down the actual potential income. What are the current rents being paid? What does the bank statement reality look like? In that Phoenix example, the seller was using rents $63 per unit higher than what they were actually collecting.
Ouch, that adds up.
Yeah, it translated to about a $6,000 annual shortfall in real cash flow compared to their projection.
Okay, so we've reality checked their income claims.
Hmm.
What about the expenses? What traps do sellers set there? What's step 2?
Step 2 is verify expenses. And again, you're aiming for a realistic projection. Sellers often, let's say, underreport things like repairs and maintenance, especially if the building's getting older.
Makes sense.
You have to use common sense and probably inflate those numbers a bit. But the absolute biggest trap, the one that catches so many people, real estate taxes.
Why is that?
Because you have to assume your taxes will go up after you buy it. The county will almost certainly reassess the property's value based on your higher purchase price. Sellers often conveniently forget to mention that.
Okay, so we apply those harsh truths to income and expenses. That gets us to the net operating income, the NOI. What is that number really telling us? Step 3.
Step 3. Determine NOI. Simple formula. Total income minus total expenses. This is the absolute key number before you factor in any loan payments, any debt service.
And in that Phoenix case.
The seller's projected NOI was nearly $30,000, but the professional realistic projection, it dropped the NOI down under $23,000. That's a difference of over $7,000. Huge.
Okay, now for the magic formula part. Turning that realistic NOI into an actual offer price. Step 4.
Step 4. Find the capitalization rate, the cap rate, and calculate the valuation. The formula is simple. Valuation equals NOI divided by the cap rate for that market area.
In applying that.
Applying that formula to the realistic NOI resulted in a fair offer price of around $256,000, significantly less than the asking price.
How much less?
The list price was $338,000. So that realistic NOI forced the valuation down by over $82,000.
Wow, that's massive. So if someone had just paid the asking price?
They'd be sunk from day one. The loan payment alone would likely have been more than the actual NOI. They'd be guaranteed negative cash flow right out of the gate.
Okay, so step 5 ties it all together, the profit.
Exactly. Step 5 is calculate the loan payment and the final profit, often measured as cash-on-cash return. Because they crunched the numbers and forced the deal down to that profitable valuation, the projected annual profit gave them a very healthy 9.2% return on their actual down payment cash. That's a solid deal. So, okay, if we connect this to the bigger picture, once your valuation work confirms the deal makes sense at a certain price and you get it under contract, the next big phase is due diligence.
Right, the 30-day deep dive. The Easter egg hunt, as the source called it.
Yeah, basically hunting for 100% of the facts, especially the ones the seller didn't volunteer.
This is where you uncover the real dirt, literally sometimes. Structural issues, maybe major fire code violations, or units that aren't actually rentable because they've been, what was the term, cannibalized for parts.
Exactly, and every single thing you find during due diligence, that's leverage.
How so?
You use those findings to go back to the seller. Either they have to fix the problems before closing on their dime, or you renegotiate the price down further to cover the repair costs you now know you'll face.
Okay, makes sense. So you close the deal, you own the property. Now the focus shifts to actually running it, right?
Yeah.
Executing the management plan and adding value.
Absolutely. Turning those operational insights you gathered into actual profit. Look at that Sun City example, the 182-unit place. The management plan directly addressed what the residents wanted and needed. The seniors there didn't like stairs. Okay, price the first floor units $75 a month higher. They wanted transportation. Fine. Budget $54,000 for a community van.
Seems straightforward, but did it work?
Massively. Those kinds of operational tweaks targeted at resident needs increased the property's cash flow so much that the whole asset appreciated by over $2 million in just 1 year.
Wow, okay. And if you, the listener, decide to manage it yourself instead of hiring a company, the sources had some pretty firm advice there, especially about rules.
Oh yeah, very firm. You have to set clear, strict policies right away and stick to them, especially around rent collection. Never waive late fees. Never accept partial payments. It sets a bad precedent.
And tenant screening.
It's non-negotiable. You have a moral responsibility, and frankly a financial one, for resident safety. That means rigorous criminal and credit background checks on every single adult applicant. No exceptions.
Okay, let's talk about the end game, the exit. The core philosophy seems to be buy and hold, build wealth long-term, but what if you do decide to sell?
If selling is the plan, then you have to manage the property differently in the run-up. You manage it for the retail price for the next buyer.
Meaning?
Meaning you have to maximize the future potential income that the next buyer will see. That means pushing rents aggressively up to full market rates, even if it causes a bit of temporary vacancy.
Why is that so critical?
The math is brutal. Let's say you have a 20-unit building and your rents are just $35 a unit below market. Doesn't sound like much, right?
Yeah.
But that little shortfall costs you $8,400 in cash flow per year. And at, say, a 10% cap rate, that reduces your potential sale price by $84,000 just from being slightly under market.
Oof, okay. And what about the risk of just selling quickly, even if it's profitable?
The biggest, simplest danger is taxes. You sell a profitable asset, Uncle Sam wants a big slice right away. That $2.5 million profit example could easily trigger a $750,000 tax bill. Gone.
So how do you avoid that huge tax hit?
Well, you have a couple of main options. Option A is usually a 1031 exchange. That lets you defer the taxes, but you have to identify and usually close on replacement properties very, very quickly, like within months.
Which means?
Which means you better have 3 or 4 other deals already scouted and pretty much ready to go. Otherwise, you risk making a bad buy just to beat the tax deadline.
What's option B?
Option B is often cleaner, simpler. Just refinance the property, pull the equity out tax-free, keep the cash flow coming in from the asset. Often a much better move than selling just for the sake of selling.
You know, the big takeaway from this whole deep dive seems to be that the difference, that gap between the golden few and everyone else, it really isn't magic, is it? It's preparedness. It's having a system, and it's taking action.
That's it, exactly. Success here, it's a journey. You gain it through discipline, through applying these methods and learning as you go. And to start building that discipline muscle now, the sources suggest focusing on small, doable things like that behavioral change to-do list.
Right, like taking a new route to work just to consciously look at different neighborhoods, see what's going on.
Or maybe just cutting out 1 hour of TV time each night and using that hour for market research instead. Small steps, but they build the habit.
And it leads to this final thought. Since a property's value really comes down entirely to its operations, its cash flow, owning investment real estate isn't passive. It's owning a business.
So if you're listening and thinking, wow, I just don't have the time for all that research, all that management, that raises a really important question for you, doesn't it? What need, not just a want, but a deep need is powerful enough in your life to make you treat this not like some passive thing, but like the active, demanding, potentially very profitable business it truly has to be.